Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. Just recording this video on my vacation, Italy, so bear with me on the content production. But I wanted to give you guys an update on obviously big week this week from the Bank of Canada, raising rates by 75 basis points. That was as expected. Of course, if you're watching our podcast on the Loonie Hour, it's exactly what we were sort of talking about. Went in depth on that, so I highly encourage you to go check that out. But I want to kind of unpack the 75 basis point rate hike, kind of how I see things shaping up from here, what central bankers are telling us, and really the implications, I think, on the mortgage market and on psychology and on how this is going to play out for the housing market moving forward. So you had 75 basis points from the Bank of Canada. They've now raised rates 300 basis points year to date. So you've got the overnight rate at 3.25, basically from 0 to 3.25. So huge shift there. And they're saying after the announcement that they've still got some work to go on interest rates. And so there was no speech from Tiff Macklem, but the following day, Carolyn Rogers, Deputy Governor of the Bank of Canada, came out and elaborated a little bit further. Funny enough, someone actually commented and asked her and said, "Hey, well, are you willing to sort of commit to, any more front loading of interest rates, any more jumbo interest rate hikes moving forward?" And she was not willing to actually do that. So if you're looking at the markets, now the markets can be wrong, the markets have been wrong. The market is still pricing the Bank of Canada to get the overnight rate to 3.75 by the end of this year. So that means there's another 50 basis points to go if the market is right. Again, the market could be wrong. Typically speaking, central bankers try not to disrupt markets too much, obviously to try to create some variance of financial stability. So the reality is you might get another 50 basis points in October, which would be another larger rate hike, 50 basis points, and pause and done. Because basically once they pause, they don't start typically raising it. It's not a typical interest rate hiking cycle. Usually it's a pause, hold, and then cut. And so that's kind of what we're looking at. Again, markets are actually pricing in rate cuts next year. Again, markets could be wrong, so don't shoot the messenger. My personal view, as I've talked about in the Loonie Hour, I think this was the last one, another jumbo front loading of 75 basis points. You've got rates at 3.25, and I think the economic data is going to deteriorate from here. In fact, it is already deteriorating. We don't have to talk too much about the housing market. I think you guys are well aware. Greater Toronto again coming in at 20-year low in home sales in the month of August. Greater Vancouver having the third worst August in the past 20 years, other than 2008. You guys all know what happened that year. 2012, another incredibly soft year economically. So housing is incredibly soft, and you're not even adjusting for population growth over those past 2 decades. So I don't really need to go too much into that. But I think the idea is that I think what most of the market commentary I think is not quite appreciating. I understand that the bank's mandate is to get inflation down. I just don't think people are really appreciating how much the economic data is going to come off with it, because the role of private debt in a developed economy is significant. And so when you take a highly levered market such as Canada in particular, they're one of the largest offenders in the G20 for not only the most indebted households, but the most indebted corporations. Yes, the corporations that actually employ those households that then need to service their debts. So Canada has one of the largest indebted private sectors. And so if you raise interest rates 300 basis points, and people go, well, rates are still low, they're at 3%. Guys, we need to quantify and adjust for the level of debt, the amount of debt. You can't compare the debt loads 10 years ago and interest rates back in the 80s and say, well, Paul Volcker in the 80s. Again, these are different levels of debt. So we always look at debt to GDP. And again, Canada's credit to the non-financial sector debt to GDP is at 365%. I mean, it's absolutely obscene. So the rate sensitivity, again, is as we're seeing 20-year lows in housing, and we're now going to start to see it into the rest of the economy. And funny enough, we actually had employment numbers out this week. 2 days after the Bank of Canada raised interest rates. So the Canadian labor market just shed another 40,000 jobs, 40,000 jobs lost. It was actually, so this wasn't a one-off. This is actually the third consecutive month of job losses. We've now lost 113,000 total jobs. The unemployment rate is now up. It's up from 4.9% to 5.4%. So this is, unemployment, sure, it's still low, but unemployment and labor statistics are actually a lagging indicator of the economic cycle. The last things that businesses will do is cut their workforce. So if you think about it, you imagine how difficult it has been to hire people, train them. You're spending money on them to employ them and get them up to speed. And so the first thing is you start to see your business, slowing down. The first thing you'll start to do is, okay, well, maybe we start cutting advertising. Let's see if we can cut a couple subscriptions here, kind of thing. The last thing you try to do is obviously, lay somebody off. And so employment tends to be the last thing to actually change in the downturn. So it's actually a lagging indicator, but we are starting to see those numbers roll off. And so I think, and that really should not come as a surprise when we look at, again, this 300 basis point increase, and let's just look at what it's done to the mortgage market, for example. So let's just assume you took out a variable rate mortgage at near the lows, during the pandemic, right? So you could have got a 5-year mortgage, on a variable rate at, let's say, 1.5%. So if you had a floating variable, so you went to Scotiabank and got a floating variable, your floating variable is up 300 basis points along with the Bank of Canada rate increases. So your 1.5% mortgage is now at 4.5%. So if you had $1 million mortgage, your monthly payment, assuming a 30-year amortization, is up just over $1,500 a month. Now, again, people go, wow, what the hell are they doing having $1 million mortgage? I mean, let's go back and just look at the benchmark price of a typical home in Vancouver, Toronto. I mean, they're north of $1.5 million. And so chances are, if you're a younger person that didn't buy your house 20 years ago, you probably bought a single family house in the 1.5 to 1.67 range, and you probably do have $1 million mortgage. And if you floated that, your payments are up $1,500. And again, what are these people going to do? Well, they're not going to instantly stop paying their mortgage. What they're going to start to do is start cutting everywhere else in the economy. And so, okay, well, maybe we don't go for a restaurant. Maybe we don't buy the new Xbox. Maybe we don't buy our kid, new shoes for back to school this year. Maybe he just continues to wear the old pair. And this reverberates through an entire economy. And again, I think this is why, GDP continues to slow in Canada. Now you're starting to see, I think, some softening in the labor market. Again, nothing to certainly panic about. It's nothing that's going to force the Bank of Canada to pivot. But I think the data is going to continue to deteriorate over the coming months. I'll give you one more example from my good pal, Ron Butler. So again, if you were a levered investor and you decided to, take out a home equity line of credit, in March, let's say you took out a $300,000 line of credit. Well, in March of 2022, that monthly payment, that monthly interest only payment would have been $733. Today, fast forward to today, after all these rate increases, that same $300,000 home equity line of credit, which you might have used to go and buy an investment property, is now $1,400. It's over $1,400. So you've seen a doubling of your interest costs in basically 7 or 8 months. And again, the idea and the question now is there's going to be some people that are really trapped, which is, hey, I borrowed on a HELOC as a down payment, and I also floated a variable rate mortgage on investment property. So that payment's now gone up, and so the rent is actually not even covering the mortgage, and I was breaking even at first, but now I'm losing $400 a month. Oh, and by the way, the BC government, which typically allows you to increase rents by the rate of inflation for the prevailing 12 months. So this year going into 2023, that should have been a 5.8% increase as per their own data and metrics. the BC government actually just came out this past week and said, well, to deal with the cost of living crisis, what we're going to do is we're going to give a break to the people who need it most, which is the tenants, the renters, and you're only going to be allowed to raise rents 2%. So we said that you could raise rents by inflation, but in order to offset the cost of living crisis, we are going to put that brunt on the landlords, and so you can only raise rents by 2%. So you're basically stuck now in a situation where if you've got a tenant already in there, you can't actually raise your rent enough to offset your rising cost of maintaining and owning that property. So there is going to be, it takes some time for this to wiggle its way through the system, but I think when we talk about stresses, it's going to come down to how long do interest rates stay at these levels. The Bank of Canada says it takes 12 to 18 months for interest rates to really work their way through the system. And I think this is all part of the same thing, right? You can sort of get away with handling a lot of these interest rate increases for a little while, but eventually the debt servicing will detract from the rest. It will impact other businesses. And again, this is never contained to just housing. And so my personal view again remains that the economic data is going to deteriorate much quicker than many people are expecting. And I think that at some point, it's probably not going to be this year, but I think maybe early parts of next year, the political and societal pressure is going to pivot from, hey, Bank of Canada, you guys need to fight inflation. Things are going up too much. This is not good. You told us inflation was transitory. You made a mistake. Now you need to do your job. To, hey, guys, what the hell are you guys doing? I can't even afford my mortgage. You guys keep raising the interest rates on top of the rising cost of food that I've had to pay, et cetera, et cetera. And, oh, by the way, I just lost my job because the economy sucks so bad. So I think that the political and societal pressure is going to come back in the other direction. But right now, the narrative is still strong that the Bank of Canada needs to do something on inflation. I think inflation comes down quicker. I don't know if it gets to 2%. I still think that central banks, similar to Greg Jensen at Bridgewater, one of the largest financial institutions in the world, would make the same argument that inflation might not get down from 8%. It might only get down to 3.5%, and it's going to leave a tough decision for a lot of these central bankers of potentially having to ease and cut rates with inflation still at 3.5%. I mean, at the end of the day, yes, it's a 2% inflation target, but it's kind of a subjective number. I mean, who says inflation should be 2 and not 1.5 and not 2.5? And so I think that this idea of getting inflation back down to this sort of hypothetical 2%, it's going to come into question. It's going to be tested ultimately. And so that's kind of what I'm looking for. I think the housing market will continue to remain weak for the rest of this year, and there's no pivot coming this year, but I think we are getting close to the tippy top of interest rates, but there's still more pain to come for the real economy as housing and that spillover works its way through. So as always, hope that helped. See you next week.